Let's talk about the one question that every single investor has on their mind. How do I get great returns, really grow my money without feeling like I'm on some terrifying roller coaster the whole time? It's the ultimate dilemma.
I mean, of course you do, right? We all want our money to grow, but that fear of a market crash, of losing everything, it can be totally paralyzing. So, is it even possible to have the best of both worlds? Well, that's exactly what we're going to break down. Just look at the history here. For almost 100 years, the data tells a pretty clear story. If you wanted those juicy 12% annual returns from small stocks, you had to be willing to stomach some absolutely massive swings in value. Now, compare that to Treasury bills down at the bottom. A pretty modest 3.4% return, but with almost no volatility, super safe. So the market's message seems to be more reward means more risk. But is that really the whole story? To figure that out, here's our game plan. First, we're going to start by understanding you, the investor. Then we'll get into the so-called magic of mixing assets. And finally, we're going to put it all together to see how you can actually build a portfolio that's just right for you. Okay, so let's dive into the single most important variable in this entire equation, and that's you. Your personal relationship with risk, how you feel about it, that's the foundation for every smart investment decision you'll ever make. In the world of finance, we basically talk about two kinds of people. You have the risk-averse investor. They'd much rather take a guaranteed $50 than flip a coin for $100 or nothing, even though mathematically the odds are the same. Then you have the risk-seeking investor, who actually gets a thrill from that uncertainty. And here's the crucial part. The entire system of modern finance is built on the assumption that most of us, deep down, are risk-averse. To turn this personal feeling into something we can actually work with, economists came up with a concept called utility. Just think of it as your personal satisfaction score for any investment. It's a way to balance the happiness you get from making money against the anxiety you feel from the risk you're taking. And the goal, always, is to find the portfolio that gives you the highest possible utility score. So, if most of us are trying to avoid risk, how do we get the growth we need? Well, this brings us to what is probably the most powerful idea in all of investing: diversification. But it's not just about owning a bunch of different things. It's about how those things work together. And the secret ingredient that makes it all work is something called correlation. It's just a number, from +1 to -1, that tells you how two different assets move. If the correlation is +1, they move in perfect lockstep, like synchronized swimmers. If it's -1, they're perfect opposites, like two ends of a seesaw. And this right here, this is the key to everything. To really wrap our heads around this, let's forget about stocks and bonds for a second. Let's tell a story. So picture this. You own a little business on the beach, renting out chairs and umbrellas. Your business is pretty good, but it's super risky. When you get a sunny year, business is booming. You make a fantastic 20% return. But if it's a rainy year, you make nothing. Zip. Your average return is 10%. But man, it is an unpredictable ride. So you decide, I've got to diversify to lower my risk. You look around and you buy the snack shop right next door. Seems smart, right? Now you own two businesses instead of just one. But look what happened. Nothing's changed. Your returns are still 20% in sunny years and 0 in rainy years. You haven't actually reduced your risk at all. Why? Because both businesses depend on the exact same thing, sunshine. They are perfectly correlated. So you need a totally different strategy. You need a business that does well when your beach shop does poorly. You need something that zigs when the other one zags. And then you find it, an old school DVD rental business.
Yeah, just go with it.
Now look at this, it's incredible. In a sunny year, your beachwear shop makes 20% and the DVD business makes 0. Your combined return is 10%. In a rainy year, it's the total opposite, but your return is still 10%. By combining these two negatively correlated businesses, you get the same average return, but you've completely wiped out the risk. And that right there is the whole point. Real diversification isn't just about owning different things. It's about owning things that behave differently, things that have low or even better negative correlation. That is the real magic.
Okay, so maybe a DVD rental shop is a bit of a stretch these days. I get it, but the principle behind it is what's so powerful. So let's see how we can apply this science to the actual world of investments.
If you could plot every possible mix of stocks and bonds and everything else on a graph of risk and return, you'd get this big, messy cloud of dots. Well, the top edge of that cloud is what we call the efficient frontier. Every single point on this curve is the absolute best return you can get for a certain amount of risk. It's simple. A smart investor would never pick a portfolio inside the cloud because you can always do better up on the frontier. Now, this efficient frontier, it's great. It's like the all-star team of risky portfolios. But what if I told you we could create a set of choices that are even better? We just need to add one more super simple ingredient to our mix.
And that ingredient is a risk-free asset. Think of a government treasury bill. When you draw a straight line from that risk-free return, so it just kisses the highest possible point on the efficient frontier, you create this, the capital allocation line. And here's the amazing part. Every single point on this new line is a better deal, a better risk-return trade-off than the points on the curve below it. It creates a whole new world of better possibilities. This all leads to a really profound idea called the two-funds separation theorem. It sounds fancy, but it's actually beautifully simple. It says the entire investing process can be split into two clean steps. Step one is the investment decision. It turns out everyone should, in theory, use the exact same optimal risky portfolio, that one perfect mix of assets right where the line touches the curve. Then, step two is the financing decision. Based on your personal risk tolerance, you just decide how much to put in that one risky portfolio and how much to keep safe in the risk-free asset. And that's how it all comes full circle. The capital allocation line represents the absolute best menu of investments available. Your personal risk tolerance, your utility curve, is what determines your unique spot on that line. So a really cautious investor might be way down here, mostly in the safe stuff. A more aggressive investor might be 100% in the risky portfolio, or even borrow money to invest even more. All right, let's wrap this all up. We started by seeing that higher returns usually mean more risk, but the real goal is finding the right level of risk for you, and your best tool for that job is diversification. But not just any diversification. It has to be powered by that magic of low correlation. And finally, all of this is modern portfolio theory, a scientific way to find that perfect mix. And that brings us to the final question, the one I want you to think about after this is over. It's really easy to think you're diversified because you own a few different stocks or funds, but are those assets really moving differently? Are they truly zigs and zags? Or did you just end up buying a bunch of different beachwear shops?